Welcome everyone to Vested Interest. This is Shane and this is our weekly portfolio update. We did add $1,537 to the portfolio this week. We will cover all of the dividend stocks we bought, any dividends we received, any options we were in for the week. But before we get too far in the video, I would like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. The channel continues to grow because of people like you. For those of you who may be stopping by for the first time on this channel, we focus on dividend growth investing. It's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks and growing companies with positive cash flow that covers the dividend and companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing into the portfolio on a weekly basis, and then we cover that weekly update. That's what this video is. But I also do larger purchases around, if we get taxes back or we get a bonus, or if, God forbid, someone was to pass in the family that has a lot of money, which there aren't a whole lot of those people in my family. But if there was, I would take those large chunks and invest them into the portfolio and then cover those as well. It is free to see what I'm doing on the channel. I do not have a paid Patreon account. I'm not trying to get you to sign up for any access, any other sites you need to go to access any information from me. It's all out in the open to see what I'm doing. Again, every week I do this portfolio update, but if you would like to help out the channel, doing these things takes a couple seconds of your time. They're free. They don't cost you anything but that couple of seconds of your time, but it really does help out the channel. So if you hit that thumbs up button down below, if you find any value in the content, drop a click on that subscribe button down there. Make sure you subscribe to the channel. Join us on this journey to financial freedom and hit the notification bell so you're notified whenever I put out any new content. Along with this weekly portfolio update, I do a Monday through Thursday stock pick of the day video where we take a look at a company stock that's pulled back on the day, run it through my screener, and see how it shakes out on the other side. There's also the thanks button down there for those of you who would like to buy me a cup of tea. Really appreciate all of you out there. Again, special thank you to the subscribers and the viewers of the channel. You guys are awesome. Doing that really helps out. So thank you all who have taken the couple seconds it takes to do all of that as well. Now, options. We have not really been focused on options at all. I think the last couple weeks we haven't even put any out. Did do some in January, but really have not had much luck there. The market has been pretty volatile, up and down. So typically that's when options do the best, but I'm very conservative with my options. I'm trying to keep the positions and also scrape off a little options premium as well. But I'll be honest, since I'm not that focused on it, I may take it out for a little while and not even have this slide. I'm kind of debating. This kind of seems to not be going very well. So like I said, may not be worth taking the time to discuss right now, especially this next week with it being a short week, missing President's Day there on Monday. So probably will be another down week. We'll see how it goes. We may just take this slide off for a little while. Now, dividends. Dividends, on another hand, have been doing pretty well. We did receive $228.65 in total. All of it did come in on the 14th, so happy Valentine's Day to me from the dividend people out there, dividend companies out there that paid me. We did receive $72.27 from Ally Financial, ticker ALLY. This is a bank out of the financial sector. And that $72.27 went right back in and picked up $1 or 1.90435 more shares of Ally. We do have the DRIP set, so that stands for Dividend Reinvestment Plan. And that just means anytime a company pays out dividends, in this case Ally, and the money they pay goes right back in and purchases more shares of that same company. And not to let Ally have all of the fun there, Enterprise Product Partners paid us out $156.38. Ticker EPD, is out of the energy sector, and that $156.38 went right back in, picked up 4.65282 more shares of Enterprise Product Partners, and the dividends paid out, the new shares that they picked up, added an additional $12.05 in passive income over the next calendar year. So that really is the amount that will be dumped back into Ally and Enterprise the next time they pay out dividends, right? So that 1205 will increase the amount that we receive when these two dividends pay out again. And that is that dividend snowball effect or compounded interest. Whenever you hear those two terms, that's what's really going on here. So we already had shares of Ally Financial and Enterprise Product Partners that we bought out of our own funds, and then those shares pay out more dividends. Those dividend payments, buy more shares. Those new shares add new capital. That is the compounding going on, right? Like whenever you're building a snowman, if you've ever done that, and you're rolling that snowman down the hill to create the bottom there, and then you roll another one down the hill to create the top, and then you roll a third one not quite as far down the hill to create the head. And that is what's going on, right? The hill is time, right? So you're rolling these dividends down the hill of time, or pushing them up the hill of time, whichever way you want to look at it. And they continue to pack on a little bit more snow. The dividends are the snow, or the income you are providing is the snow, and they get bigger and bigger and bigger and bigger. And the longer you push them down the hill, the bigger they will get. Even if you don't add new capital, the dividends will do their thing over time eventually as well. All right, over to the very first new capital invested. We went in on Monday and added $998.58 to the portfolio. With those funds, we picked up 4 more shares of Comcast Corporation, ticker CMCSA, out of the communications sector. Picked up those 4 shares at $34.58. This one remains below our cost basis. We're going to continue to nibble there. This is part of our monthly buys and monthly focus for February, if you did not catch that video. Cisco Corporation, ticker SYY, same thing, another one on our list to continue to add in February, and it's not below our cost basis, but we did add those 4 shares at $70.20 per share, which is very close to our cost basis, right around $69 per share. So this one is just so close that it's close enough for me. Again, not below my cost basis, but one position I'd like to build out, and it will continue to do so long as it stays, below $75 or lower, or at least through February. That was our focus for this one. And the third one we were focusing on is actually 4. LyondellBasell was another one, but we didn't add to that one this week. But this was one of the ones we wanted to focus on for February as well. Occidental Petroleum, ticker OXY, added 12 more shares there at $48.29. And we're looking at this one, anywhere from $53 and lower. We're going to continue to add to this one. I'd like to get it over 200 shares. I think I'm right around 170, 160, 170, something like that. I will see that here at the end of the video, our overall portfolio. But this $998.58 added. The new shares we picked up with those funds added $24 in new capital over the next calendar year. And we weren't done. We went back in on the 14th and showed a little love to the portfolio as well there. So happy Valentine's Day to the overall portfolio. We added another $538.75. Picked up 5 shares of Schwab Strategic Dividend Growth ETF here, ticker SCHD. We typically do around 3 shares there, but figured we'd add a couple extra at $27.87. And this is one we are going to add to as well as so SCHD as well as Vanguard's Total Stock Market ETF, ticker VTI, are ones we are adding to every week regardless of the market. So we did pick up 1 more share of Vanguard's Total Stock Market ETF, ticker VTI, at $302.24. These are 2 ETFs, again, that we just add to every week. And last but certainly not least, we went in and added 10 more shares to our Vale position, ticker VALE. This is out of the material sector, a mining company out of Brazil here. Picked up those 10 shares at $9.72. This one's well below our cost basis. We have dropped our cost basis significantly over the last several weeks, from above $12 to the mid $11 range. And I want to continue to do that as long as this one is down. So the $538.75 we added, the new shares it picked up, added an additional $18.59 in passive income to the portfolio over the next calendar year. Total invested for the week, $1,537.33. Total passive income added with the new funds we added, as well as the dividends paid out, and the shares they picked up added $54.64 in passive income to the overall portfolio. So last week we actually went down because we did reallocate a little bit, but back on the upswing we go. Love to see that passive income added. All right, and a quick run through the portfolio as far as the sector weights go. Communications makes up 10.48% of the portfolio. Consumer discretionary at 2.14%. I'd like to add to the Haverty Furniture Company's position we have. That's well below our cost basis, so probably looking to add a little bit here. Maybe nibble a little bit and then really focus on it next month if it remains below my cost basis. But at 2.14% for consumer discretionary, wouldn't even mind adding a new position. I know a lot of people are looking at Nike right now, several others out there that have really pulled back, but we'll see. Right now, really not looking to add any new positions to the portfolio, and I do have a bit of a rule right now. If I do add anything new, I want to pull something out to replace it, or pull a couple positions out to replace it. That's kind of what I did over the last couple of weeks, reallocating some funds, reduced my overall share count, and then really juicing up the dividends in the existing positions by reallocating those funds over the overall position. So I'd like to continue to do that and build out some existing positions before I add anything else, but we'll see. I only do have the one position outside the ETFs in consumer discretionary. But consumer staples makes up 7.58% of the portfolio, energy at 8.4%, financials makes up 2.75%. Healthcare is the number two position, second largest position in the portfolio at 13.71%. Industrials makes up 7.35%. Technology, that is the largest position at 14.81%. If Google was to stay down in the low 180s or below, I'd love to add it under 170 in the 160s or below, but I may nibble a little bit while Google's in the 180s. We'll see. Again, I'd like it to pull back a little bit more, but it may not. Materials at 9.19% of the portfolio. Utilities makes up 7.95%. REITs and real estate at 5.38% of the portfolio. And ETFs is now not quite the third position. Communication still makes up that third spot, but it will eventually overtake the overall portfolio just by the nature of adding to ETFs, VTI, and SCHD every single week. But still rounds out the fourth spot there at 10.24% of the overall portfolio. And over here to the right, you can see those same percentages broken down, matches the pie here on the left, as well as the dollar amount allocated to each sector as well. All right, here it is. I show this every week. I think it's important for those of us on the YouTube space here that are talking about finances to show you what we are doing, so it's not just talk. It's very easy to sit online and tell people what they should do, but then if you are not showing them what you are doing, how do we know if you're taking your own advice or if you're not just talking out your backside? We don't. So I show my portfolio every week. I think it's important, again, for transparency purposes, as well as to help some of you out there understand you can do it too. You do not need to pay a financial advisor big fees to manage your portfolio. I'm just an average person. I'm not some financial guru. I did not go to college to this. I was not raised by a rich family. I didn't get a bunch of money to build a portfolio or start a portfolio. Any of that, my parents, short of my dad's retirement account he has through the union, they've never invested anything, I don't believe, in any kind of investments accounts that I'm aware of. Maybe they're hiding something, and whenever they pass, I'll get some big account that I wasn't aware of, but I really doubt that. Neither one of my parents graduated high school. I was the first one in my family to graduate high school. So if I can do it without a financial background, I have learned as I've gone. I have made mistakes. If you've watched the channel, you've seen those mistakes. And you will make mistakes. That is the nature of investing. Even the greatest investors in the world make mistakes. That is what a lot of people will consider the cost of admission or your education, the cost of education in investing, right? So don't be afraid of it. Try to keep those mistakes minimal. If you don't want to do any research into stocks, for example, and learn how to value individual stocks, then what you should do is stick to ETFs or index funds. And Warren Buffett would recommend something that tracks the S&P 500, something like VOO, Vanguard's S&P 500, or SPY, or several of the other ones. Schwab has several out there. Spider ETFs that track the S&P 500. Vanguard, again, has some. I know Franklin Templeton has some. Every single brokerage account out there, BlackRock, if you choose that one, will have some funds that track the S&P 500. Pick one that you like, with the lowest fees that you can get. You can get some 0.006, 0.003 fees there, and just plug your money away. You don't have to worry about individual stocks. You can just do the same thing with dividend growth stocks, something like SCHD, VYM. SCHD is what I have, and then VTI tracks the total world stock market. But like I said, Warren Buffett would recommend something that tracks the S&P 500 for the average investor, so I'll recommend that to you. But I've chosen VTI, which is just the total U.S. stock market, not just the top 500 stocks. But I have SCHG, which is a large cap growth ETF in my daughter's custodial accounts. So there's a lot of them out there. If you want an ETF or index fund that makes it easy and you don't have to do any research into individual stocks, nothing wrong with that. I'm sure it'll help you. A lot of people out there who don't know what they're doing sleep well at night, and allow you to get money into the market that can grow over time for you, and eventually you can utilize to live off of in retirement. All right. Hopefully showing you this every week gives some of you out there who are on the fence a little bit of courage to start, or some of you who maybe have just started and maybe you're seeing some downturn, right? Maybe you're seeing some of these 11% drops, 10% drops, 13% drops, 15% drop, right? 15% drop. These are normal. I mean, it happens. And Warren Buffett famously said, if you can't handle a 50% drop, so half of your money seemingly vanishing overnight, you shouldn't be invested in the stock market, because it is going to happen. You know, VTI is probably going to drop by 20-25% at some point, the whole stock market. SCHD has dropped, you know, by 4 or 5% at times. It happens. These stocks are down, like I said, 11% plus, 3% for NTR. Drops happen. But if you've done the research, you understand the companies you're invested in, they're good companies. Those downturns are when you should be investing more into those positions. Now, if they're junk companies and you don't know what you're investing in and those downturns happen, you may, you know, scramble and sell at a loss, right? And you don't sell or gain anything, right? Where you see these gains and losses on total return, percent return, those are only locked in when you sell, right? It doesn't mean anything whenever they're just sitting out there. Ooh, I'm up $2,000. Okay, I can't use that $2,000 unless I sell all the Kroger position, right? Ooh, I'm up $3,500. Well, I can't use any of that unless I sell out of AT&T completely, right? So that's the nature of it, right? Owens Corning, I can't use this $400,000 or $4,000 I'm up. I wish it was $400,000. It's $4,000 I'm up. I can't use that unless I sell all of my Owens Corning positions. So it's nice to see total return going up. It is. It really is. I like it, but it is not my focus. I focus on the dividends returned out. Okay, but I'll get off my soapbox and we'll run through this slide so we can get through the video here. So total positions in the portfolio here, all the tickers in the first column, total shares of each, and all of these numbers will be as of the close of business on Friday. My current, or the current price as of the close of business on Friday, market value, my average cost per share here, purchase price. This does include reinvested dividends, so this is just not just funds out of my pocket. It, like I said, does include reinvested dividends. So that's going to be a little bit misleading maybe whenever I say purchase price. Like, I don't just have $6,310.56 of my money into Ally. As you saw, they paid out dividends this week. So this number does include those dividends. Total return up or down here, $3,005, like for example, $3,005.95. I am up, right, significantly on this position, but this also does include reinvested dividends. Percent return here. So if I'm down on a position, you see it. If I'm up on a position, you'll see it. And that can change very quickly. We'll talk about one that did change very quickly this last week. What sector the company falls in, quarterly, monthly, semi-annual payer, current yield of the overall portfolio and each individual position here. Yield on cost, my yield on cost. You want this number to be higher than the current yield, right? And it should be over time as long as your portfolio is growing. Portfolio weighting. So on the previous slide, we saw each individual positions weighting, or I'm sorry, in each individual sector's weighting. In this slide, we see each individual position's weighting. And I do have a rule in the portfolio. I do not want any individual position or to be more than 10%, and I don't want any individual sector to be more than 20 to 25%. That does not include ETFs, right? VTI and SCHD. If they become more than 10% of the portfolio or more than 20 to 25% of a sector, overall sector, then that's fine. Estimated annual income here, payout months here, dividend growth year over year, and where a company sits at 15% of a 52-week low. For this column, this really just gives me a high watermark, right? If I wanted to continue to add to Ally, it's up significantly, up 47.63%, for example. If I wanted to continue to add to Ally, I could certainly do it. Even though its current price is $38.37, I wowould just make sure I didn't add any more than would take this average share price above $33.40 of a 15% of a 52-week low. So it's the high water mark I want for my average cost per share. That's it. That's all this number is, right? I would like to add whenever positions are below this number. For example, SYY. I've been adding. It's still above my cost basis, right? I'm up 2.32%. My cost basis is $69.48. So I've been bringing my cost basis up slightly as I've been adding to this position. I bought it this week at $70 and some change. It's right now $71.09. So next week, if it's over $71, I still want to add to it, right? It'll bring this number up a little bit. But so long as I don't bring it up above $79.38 per share, that's fine. I can add to this position. Now, this is one case where the current price is below 15% of a 52-week low, and my average cost per share is below that. So I like to keep the current price below this number, and that's when I'd like to add to it. Union Pacific's another one, right? $207 share price, $207.81 is how much I have into each visual share. It's currently at $249.17. But 15% of a 52-week low is $251.33. So it's currently below that, and it would keep my average cost below that. So that's just the number I want. $251.33, for example, I want my average cost to stay below that. That's all this is. This will adjust over time as where it sits at 15% of a 52-week low adjusts. All right, total shares in the portfolio, 6,857.858 shares. Market value of the portfolio, big turnaround this week actually, $338,170.58. I do have $310,271.07 of my own capital into the portfolio, does include reinvested dividends. And I say that's my capital because if I turn off the drip, those dividends would be going in my pocket, right? So it's money either from my pocket or that could have went into my pocket in the form of dividends reinvested. Total return, I am up $27,899.51. Like to see that. It's nice to see I'm in the green, but I've been down at times in total return, negative at times in total return. And I am up 8.99% of the overall portfolio. Again, love to see this. And before we go any further, I would like to address one position here. CVS, for example. CVS just last week, I think we were down 15, almost 16%, if not 16%, just last week. We are up 2.11%. That is how volatile the market can be at times, right? A 16% on return on CVS from being negative to being now positive 2%, maybe even 18% return over just the last week. Is CVS a different company this week? Right? No, they just had an earnings report that came out that was better than expected. So we had some negative news around CVS, the healthcare sector, some of the issues, maybe Amazon's taking over. They're going to ship all your pills to your house now. CVS is going to die. And it really dropped the stock price. And if you saw, I was continuing to buy CVS. I bought it down. I continued to buy it down. I continued to buy it down 16%, 18%. A lot of people would be like, oh my God, that's terrible. You're down 18%. You should sell it. Well, why would I sell it? I would have lost. I would have been down. I would have locked in a loss, several thousands of dollars, because I was down 16 to 18, almost 20% at times on this one. And now just a week, like that, the snap of a finger, just in a couple of days, up over 18%, back in the positive for this position. That is the nature of the stock market. There are going to be times when the stock market really punishes a company, bad news, bad press. It's tied into other sectors that are getting bad news, right? The rest of the healthcare sector didn't really bounce back. J&J's up 5%. Pfizer's still down 15%, right? This is what CVS looked like last week, 15, 16% down, right? 17, if not $2,000 loss. Now it's back up. That is how quickly things can turn around in the market, or that's how quickly things can go south in the market. So again, you really need to understand what you're buying. If I wouldn't have known what I had with CVS, I might have freaked out and thought, oh my gosh, I'm down 20%. I should sell this and lock in that loss. But I didn't. I just held, and I actually bought more, brought my cost basis down. Wish I'd have bought even more. If I'd have known, this week it was going to pop by 18%, last week and the week before, I'd have been dumping thousands and thousands of dollars into this one. But I kept my head on myself. I just kept adding to it here and there, 4 shares, 6 shares. I think when I reinvested, reallocated, I added 10 shares, 20 shares to this position. Now it's one of the largest positions in the portfolio because I was adding, and it also turned around and is back up 2%. That's how quickly things can turn around. And I also want to touch base. I see a lot of videos, people say, oh, stay away from high yield dividend stocks. You'll lose money. That's not the case, man. That is not the case. It is very, very specific to positions. You need to understand the position. This dividend yield last week was at 4.6, and at times when it was really pulled back, it was at 5% yield. If you avoided this position because it had a high dividend yield, you would have been making a huge mistake. That is not a reason to avoid a stock just because it has a high dividend yield. As a matter of fact, when you are buying stocks, if you are buying them when they are the cheapest, they will, especially dividend stocks, right? They will have the highest dividend yields when you are buying them the cheapest. That is how it works. When they pull back the most, their yield increases the most. That's when I want to buy dividend stocks. I want them to be yielding the highest amount possible. If they're good companies, Let me repeat that. If they're good companies, I want them to be yielding the highest amount possible when I am buying them, right? Vici, I just recently added Vici to my portfolio. It has a high dividend yield, 5.7%. Should I have avoided it because it was a high dividend yield? No, I don't think so. And as a matter of fact, I want to be buying it again when it's even a higher dividend yield because I want to buy it under my cost basis. So the idea you should avoid high dividend growth stocks just for the mere fact they are high dividend growth stocks or have a high dividend, that's just a misnomer. Don't let people tell you that. Now, if they're just a high yielding stock because they're like some covered call, like some of these yield max funds, I think some of those are crazy. The NAV erosion on those is pretty crazy. But something like CVS, look at this. CVS is growing its dividend by 9.94%. So I have a 4.1% yield because I kept buying it when it was below my cost basis at a close to 5% dividend yield. Now it's at a 4% dividend yield. See that? That's in 1 week. So its dividend yield dropped by 1% because it came back up. Now, a lot of people will be like, yeah, now I want to buy CVS. Well, why wouldn't you have bought it when it was 20% cheaper? That doesn't make sense to me. Why now that the dividend yield is lower would you be all right with buying it? Same company. Fundamentals of the company are exactly the same as they were before last week started. Same exact company. And some people would have avoided it because it had a high dividend yield. Depends on the stock. Depends on the reason for the high dividend yield. Depends on what the payout ratio is. There's other things that go along with it. Don't just look at yield. You should not be looking at the yield of a stock until you figure out the price of the stock to begin with. This should be one of the last things you look at, right? I don't look at dividend yield is not even on my screener, right? Where it sits at 15% of a 52-week low, stuff like that, maybe, but dividend yield is not on my screener. I do look at dividend yield theory. Is the current dividend yield higher than its dividend average, which speaks to undervaluation, right? So there is some yield that I look at, but I look at its historic average compared to itself. I'm not looking at it as I want above 3% dividend yield. I mean, I have stocks that have a 0.43%. Look at Google, 0.43% dividend yield, right? But I also have stocks like Vici at 5.7, Verizon at 6.6, right? CVS was, my yield on cost is 4.1, and it was almost 5% just last week. So be careful whenever you're listening to some people out there who are focused that high dividend yield means bad companies. That's not necessarily the case. There's a lot more that goes into it than that. All right, current yield 3.761%. My yield on cost 4.1%, and this is what I focus on. Again, it is nice to see that I'm up 27,000, but that doesn't mean anything to me. Total return does not mean anything unless you are selling out of the shares of the companies in your portfolio. You can't use this, right? Unless you sell, you can't use this, or unless you get a bank to give you a loan against it, you can't use it, and then you're paying back the loan, right? But this, the estimated annual income currently sits at $12,719.58. I can use this. I can use this when these companies pay out the dividends. I can decide to turn off the drip and put this in my pocket. That's why I focus on this, because it's what I'm going to eventually use. And actually, in my portfolio, what I'm going to do is I'm only going to use 70% of my dividends. That gives me money to continue to reinvest in the portfolio. So even whenever I am done with the drip on my portfolio, I will still manually drip back into the portfolio. I only plan on ever pulling out 70% of dividends. The rest will go back into the portfolio. That's the idea for me. That will continue to grow my portfolio over time, grow my dividends over time, as well as allow me to pull out dividends whenever I'm ready to do so. So $12,719.58 in dividends, back on the right track. The positive growth in the portfolio is what we want to see. And last, dividend growth year over year, 7.19%. Sorry if I jumped on a couple of soapboxes there, guys, but wanted to make sure that those of you out there, I know some of you watch other people in the space. There's nothing wrong with that. I do too. That's why I know what's going on in the space. Just be careful. Dividend yield should not be even something you focus on whenever you are valuing a company. This is a byproduct of owning a company, right? They have a yield. They'll have a yield if they're paying out a dividend. So this is a byproduct. I don't look at it whenever I'm making my decision, right? Whether or not I'm going to buy a company. Now, if I have two companies that I equally like, let's say one is CVS and one is, I don't know, some other company, Walgreens, for example. I actually did this a few years back now. I looked at CVS and I looked at Walgreens. I compared the two companies. I thought CVS was the better company. I believe Walgreens had the higher dividend yield. So if I was just chasing yield, dividend yield, I would have bought Walgreens instead of CVS. But I thought CVS was the more sound company before I ever looked at the dividend yield. So that's how you should be valuing companies. Value the company first. The yield will be the byproduct of that company. How well do the companies going to do in the future? Is it currently undervalued? Right? Is the growth there? Is the revenue growth there? Are the margins still expanding? Are they paying down debt? Are they buying back shares? What does their price to book look like? What does their PEG ratio look like? What does their price to sales look like? These are things you should be looking at. And then whenever you buy the company, well, what's the dividend yield? Oh, okay. And again, if you have two companies that you've already done the research on, maybe that's the deciding factor. Let's say I liked CVS and I liked Walgreens and they were equal companies and I liked them both the same and I thought they were going to grow the same. I didn't think that at the time. That's why I bought CVS versus Walgreens. But let's say I did. Let's say they were very equal companies, everything considered, and one of them had higher dividend yield. Maybe that's the way you make the choice. Or maybe one of them had higher dividend yield but slower dividend growth, right? Well, I would take the slower dividend growth and I would take the lower yield higher growth versus the higher yield slower growth. Sure, that makes sense if they're two equal companies. But if they're equal companies and one has a high yield, I don't just say, well, this one has a higher yield, so I'm going to go with the one with the lower yield because I don't want to buy high yield stocks because it could be a dividend trap. That's just the wrong way to look at it. Dividend yield should be one of the last things you look at, if look at it at all. I look at it as a byproduct of owning dividend growth companies. That's the way I look at it, right? Nice to have high yielding stocks, but that's not the end all be all, right? Again, Google, for example. If I didn't want low yielding stocks, and I have no idea if it's going to have good growth or not yet. It hasn't raised its dividend yet. But I'm willing to say it's probably going to be close to Microsoft and some of the Apple, some of the other ones out there that are growing around 10%, their dividend. That's what I'm estimating its growth at. But I also think it's a great company, and I bought it at a great price. That's really why I bought it, not for the yield. That shouldn't be a focus for anyone who's investing. Hopefully I push that thought home there. You understand what I'm saying, and I'll jump off my soapbox. And that is really it for this one, guys. I wanted to address that this morning just because I do see there is some push out there really making it sound like you should avoid altogether some high dividend yielding stocks, right? Look at their payout ratios. If it's a high yield stock and you have a question, what's the payout ratio? Verizon, for example. Yep, there's a very high dividend yield, 6.61%. But their payout ratio is not very high. I think it's in the 50s or lower as far as their overall payout ratio. So they have room to raise this. Now, they're not raising it very fast, 1.91%, but I'm all right with starting out with a 6.61% dividend yield and 1.91%. Someone starting out with a 2.15%, let's say Union Pacific, for example, 2.15% dividend yield. I'm also okay with that and only 0.77% growth. I think they're going to increase this growth over time. Their payout ratio is pretty low. But if I did these two, added a dividend calculator together for this one and added a dividend calculator together for this one, let's say Union Pacific starts raising their dividend by 20+% a year. It's going to take decades, and that's only if they maintain the same dividend growth for them to reach the same payout ratio as Verizon. And Verizon, with a 50% payout ratio, only increasing at 1.91% over decades, I'm going to have an 8 to 10% yield on cost, maybe more. And that's if they don't increase their dividend. A slow-growing company that's slowly growing its dividend can increase that dividend growth over time, just like a fast-growing, low-yielding dividend company can decrease their dividend growth over time. That happens. So I don't really look out past 10. It's nice to look out 10, 20, 30 years and say, this is what my portfolio is going to do. But you need to manage a portfolio every week, right? Things can change quickly. CVS, for example. A lot of people might have been selling this last week because they were down 10, 15, 20%. This week, you're up 2.11%. That's how quickly things can change. CVS is exactly the same company it was last week. Okay, I'm done. That's it for this video. Hopefully you have a great weekend. Hopefully you had a great Valentine's Day, and President's Day is Monday, so remember the market is closed. All right, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the video. Let me know what you think of what's going on in the market. How is your portfolio doing? How are you doing in your positions? Do you have some like CVS that have really rebounded, or do you have some that are still down significantly? Would love to hear from you. I do personally read and respond to the comments. I'm always interested to read your questions and or opinions and suggestions for future topics. So if you have some companies you'd like me to cover in the Stock Pick of the Day video series, for example, drop them in the comment section down below. I'll work them into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping in. Thanks for tuning in, and have a great rest of your weekend. And happy President's Day tomorrow. For those of you who are off, enjoy the day. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investor journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.